From New York City for our viewers worldwide, I'm Sonali Basak, and it's the last show of the year for Bloomberg Real Yield, and it starts right now. Coming up, a triple whammy of headlines hits markets. A hawkish Fed, inline PCE, and a possible U.S. government shutdown. Stocks and yields taken for a wild ride as investors dial back from the Fed-induced sell-off. And all of this leaves 2025 looking uncertain. But we begin with the big issue, deciphering the Fed's rate path in 2025.
There's just a lot of uncertainty. Everyone's got a lot of uncertainty at the moment.
And this is a Fed that is probably deeply divided, that don't have a clear idea among themselves what they should be doing next.
I think it's going to be a constant recalibration process as we get new information hitting the tapes.
The easing bias is still there. The question to me is, does inflation get in the way?
What they're afraid of is a stagflationary environment.
The longer the FOMC takes to achieve its 2% target, the more risk, I think, that comes around those expectations being unanchored.
If you want 2% inflation, it's going to be really hard.
We are anticipating more cuts next year.
I think important not to anticipate anything and to wait and see how this unfolds.
I want to take a look at the volatility we have seen at the short end of the curve, the two-year yield this week. We've been paying attention so much to that long end that we've lost track of what's right in front of us. You saw after the Fed decision, just the two-year shoot higher at one point this week, and you have seen it hit above 435 before dropping back down to end the week below 430. But let's flip up the board here and talk about the two-year in relation to the longer term as well, because you did see the Treasury curve steepen, and you have seen at one point it steepened to the most since 2022, and you've also seen it really move in one of the most drastic fashions so far this year. The problem is now investors are being met with a bear steepener, and we'll talk about the ramifications of that later in the show. But we're going to stick with the Fed right now, because San Francisco Fed President Mary Daly joined Bloomberg a little earlier. She emphasized the need for a slower pace to cut rates.
Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. My projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Joining us now, George Bory of Allspring Global Investments and Brian Rehling of Wells Fargo Investment Institute. George, we were talking about that bear steepener just a second ago. How do you read that?
Yeah, I think the bear steepener is very logical for where we are. Number one, as you just mentioned, that the Fed kind of pumped the brakes a little as with respect to sort of future rate cuts. They want to create as much optionality, we think, in their sort of forward projections. But the economy is still doing well, and then the mix of policy likely to come from the new administration on balance is fairly growth positive. It should be fairly constructive from a capital formation perspective. But the rub, the risk here is that there are some inflationary components to it that the bond market is having a hard time digesting. So we're not surprised about the bear steepener. We're sort of set up for a steepener, and the bear component is just this extra element of uncertainty that's worked into the markets over the last week or so.
Now, I also want to bring up what's been happening inside the Fed, because we've had some really interesting dissent. And part of that has come from Beth Hammack, the newcomer at the Fed, of course, over at Cleveland. You've seen her talking about monetary policy that she believes is not far from a neutral stance. She said she prefers to hold policy steady until she sees further evidence that inflation is resuming its path to their 2% objective. Now, Brian, do you believe that? At the end of the day, do you believe that we are near neutral?
Well, I mean, the economy says that we might be. I mean, the economy's done better than I think the Fed expected, better than many expected up to this point. It looks like it's pretty robust going into next year. So there's really not a reason, I think, for the Fed to get much more aggressive here. Tap the brakes and see how things develop. But if you look around, you look at the economy, it says maybe neutral isn't that far away. So maybe the neutral rate was quite a bit higher than everyone thought back in August, September.
Now, George, how do you feel about this dynamic, and what do you think it means in terms of the number of cuts we see next year?
Yeah, no, well, we think neutral is much higher than it was. I mean, we sort of working still around that 3.5% level as neutral, but we don't need to be there tomorrow. The Fed has to evolve with the economy, and as we've seen, inflation is sticky with some very, very sort of slow kind of incremental movement lower, so they can be a little bit patient, so the orientation is still lower. But in reality, as Brian just mentioned, the economy is doing well, unemployment is still low, the job market is holding together reasonably well, and so there's no urgency to push rates meaningfully lower. And as I just mentioned before, the prospect of material change coming from the fiscal side is something the Fed will have to contend with over the course of next year, and they simply don't know how the interplay of those factors is going to roll through the economy. So we think it is sensible to take it a little slower.
Now, it's interesting because as we talk about higher for longer, there's a question of how high, isn't there? Arif Hussain of T. Rowe Price is saying that now is the time to add duration. He says, quote, that the 6% 10-year Treasury yield, he asks, is it possible? Why not? But we can consider that when we move through 5%, the transition period in U.S. politics is an opportunity to position for increasing long-term Treasury yields and a steeper yield curve, he says. Now, Brian, would you take that kind of risk of adding duration at this point in time?
I think you can slowly think about it. I like it more of a play as the 10-year gets up around 5%. If we do have inflation sticky, let's even say above expectation, 3%, 2% growth, 5% seems reasonable to me. I think we'll have a hard time pushing a lot higher than 5% unless the bond vigilantes show up at some point, again, which I don't expect in the coming year.
It's funny about the bond vigilantes. You see what's happening in Washington today, and you wonder how quickly they're going to show up with how much infighting you're seeing. George, how quickly do they show up, if at all?
Well, I think rather than just taking a simple directional bet on duration, which is always difficult to calibrate and often difficult to predict, the curve has been steepening, and that is sort of a much more kind of directional view that we think is implementable in a bond portfolio. And so the important thing about duration, it's a very powerful tool in a bond portfolio. At this point in the cycle, could we go to 6%? It's possible. It doesn't seem likely at this point, but it's definitely possible. We think you should rather diversify that duration. There are different types of duration in different securities all around the world, some of which will see price appreciation. You want to be in those securities. Those are more in the front end of the curve rather than the long end of the curve. They're in the lower parts of the rating spectrum. In many instances, they're also outside the country. So that diversified form of duration is much more powerful than just an up-down view on U.S. Treasuries.
Speaking of the Treasury market as well, when we sit here today up in New York, down in Washington, you have the GOP fighting with each other. You have Elon Musk weighing in. Yeah. And if we had this conversation months ago, what we would have been talking about is much simpler math, right? This idea that maybe tariffs could get in the way with inflation, but now it's getting more complicated when you are worried about what the debt limit looks like at the end of the day. Brian, when you see what's happening in Washington, how does that complicate further the picture for next year?
I mean, it injects some uncertainty, of course, but I don't view it as anything new. We've seen dysfunction in Washington for a long time. Now, as you mentioned, we do have a number of key items that need to be resolved. We'll have the expiration of the tax cuts. Of course, we have the spending issue and then the debt ceiling as well. So bond investors will be watching all those closely to see if there's any big movement from what we've seen in the past. But quite frankly, I view it more of a bump in the road for the time being. I don't see a real seismic change as it comes and as it pertains to fixed income investors.
Call me naive, but do the bond vigilantes show up, George, if you raise or eliminate the debt ceiling?
Yeah. No, I think that's a great point. And Brian's right. The trajectory is sort of in place, but there are flashpoints along the way that could materially sort of change the trajectory. The U.S. government's fiscal position is likely to erode and could erode meaningfully over the next couple of years. Eliminating the debt ceiling it takes away sort of at least the notion that there is some form of control that sort of forces people back to the table. Will the debt ceiling go up with every sort of meeting? Yes, it absolutely will. But if it's sort of an unbridled, sort of open sort of opportunity to just spend as much as you want, I think that would start to create some lack of confidence, and you'll see that in the long end. I think the very important part to look at is inflation expectations. They remain fairly well anchored, and so until that starts to move significantly, medium-term inflation expectations, it's hard to get too worried about it. But any one of these variables could be a trigger point that radically changes both the market's expectations and pulls those bond vigilantes. Actually doesn't pull them into the market, it pushes them out of the market and demands a much higher term premium out at the long end of the curve. And that's really what we think is going to happen over the course of 2025, that you will see a bigger term premium in longer dated treasury maturities. That will sort of spread across the bond market, and there are ways to sort of offset that with credit, with munis, with international bonds, and that will be a large part of what a bond investor will need to do over the course of next year.
If you thought yields were interesting now, 2025 could get more interesting. George Bory of Allspring and Brian Rehling of Wells Fargo, we thank you both for joining us, of course, at the final real yield of 2024. Now up next, the auction block. Wall Street strategists forecast growth for 2025 high-grade bond sales, with one estimate predicting a record year. We're going to hone in on credit next. This is Real Yield on Bloomberg. I'm Sonali, Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we wrap up the year for credit and issuance. First, we start with this week's notable Treasury auctions. We had the 20-year and the 5-year tips. Both sales tailed, with the 20-year having the highest yield since April. Over in U.S. high grade, sales came to a halt due to this week's Fed meeting. 2024 finishes with sales totals near $1.5 trillion, with activity topping forecasts for most months, including December, which was the month's second busiest going back to 2017. And we're still keeping an eye on the U.S. leveraged loan market. December's record total now stands at around $190 billion. Thanks to this loan repricing surge, this has been the busiest 2-week stretch ever for launches, and this year's volume tops $1.3 trillion, easily breaking the annual record. And looking ahead to next year, BlackRock's Amanda Lyman lays out the case for buying credit amid an uncertain macro backdrop.
I just think you need to be very clear about why you're buying credit in 2025. We're recommending to investors, buy it for yield, buy it for carry. Don't buy it because you think spreads will tighten materially, and don't buy it because you think rates are going to fall dramatically. Both of those kind of tighter spreads and lower rates would boost total returns in the typical way through the duration exposure. This is a very nuanced argument. So we're actually quite constructive heading into 2025, but recognizing that it's really for yield-based demand.
Joining us now, Elizabeth Han, Global Head of Leveraged Finance Research at Fitch Ratings, and Callie Burton, High Yield Portfolio Manager at Barings. You think about the year that was. Callie, I kept on talking to you all year about where spreads have been, yet they have been tighter and tighter and tighter throughout most of the year. Yet you look at where yields have been, and now this higher for longer environment. Is it a blessing for 2025 in some ways?
Yeah, I have to agree with the commentary that Amanda provided earlier in terms of being constructive looking out. And I know you just mentioned loans as well. And despite our team being super busy getting through all the repricings that have occurred this year, we actually like loans in this market too. Given a context of higher for longer, you just have continued attractive carry in that market. So actually in our bond funds, we utilize loan buckets to be able to enhance our returns that much more as we go out into the year. But we still see a lot of places for opportunity in the global high yield market. We've been spending a lot of time talking to investors about how bifurcated it is at this point in time. We've been looking at legacy issues that came to our market before 2023. Those remain pretty discounted in price overall. They also have short duration profiles to them. So we're looking for those pull to par stories in that segment. And then in the newer vintage bonds from 23, 24, they've provided investors with coupons in the high 7s, 8% context. So nice contractual income there as well. So even though on the surface of things, the market's in this low 7% yield context, 300 spread context, which looks historically tight, I think the yields are still working, and I think there are definitely places to find value.
It's a perfect setup to talk about leveraged loans as well. You have just seen that year-end comeback come in so hot. Elizabeth, how do you see this playing out going into next year? Have you seen a lot of that issuance come to the surface now to front run something that could be ahead, or do you see a lot more where that came from?
Right, so that's a great question. As you noted, 2024 has been a tremendous year for the leveraged loan market, surpassing the $1 trillion mark for the first time in history. And then, as you note, there was a tremendous amount of activity just in December. A lot of deals were launched. Some of those will close in the first quarter of next year. Activity this year was dominated, however, by repricing and refinancing activities. So that's companies extending existing debt. M&A and LBO volume still was a little bit lower volume-wise than investors had hoped. And that was due to still elevated valuations and also just this ongoing disconnect between acquirers and their target companies. However, we do expect, and there is optimism in the market, that things will improve on the M&A and LBO front in 2025.
It's an interesting pipeline that could be ahead, as you've been mentioning. Kelly, you mentioned some form of caution as well, recalibration. Where do you start to get cautious, if at all?
Well, I think it's more of a sector by sector, credit by credit discussion in terms of caution. So there's areas of the market we're being a little more careful on, such as energy. We see a lot of price agnostic new supply coming on in 2025. And so we see that supply demand dynamic shifting against us. We're also going to be cognizant of anything housing related. So in a higher for longer environment, these mortgage rates remain too high to be affordable for consumers. So those are areas we're definitely cautious on, but many sectors we feel like are still very investable. The credit market overall remains very up in quality. So even in the sectors that could be more challenged, it's still dominated by a lot of double B, high single B issuers that are doing just fine from a capital structure, free cash flow standpoint.
Now, where's the caution with leveraged loans as well? If there's excitement around kind of the new issuance that's coming to the table here, of the default rates that you're seeing currently, where do we stand relative to history, and what's expected next year relative to today?
Great question. So default rates right now in the leveraged loan markets, they're going to end the year in the 5% range. We're at 5.1% right now, and that's right within our forecast of 5 to 5.5. For 2025, we have forecasted default rates of leveraged loans in the 3.5 to 4% and 2.5 to 3% for high yield. So those are lower. The leveraged loan rate is lower going into next year. And the reason why is because a lot of issuers that we had forecasted to default actually have already forecasted. So a lot of fewer companies are going to be forecasting next year. But you have to put those rates also in terms of the historical context, right? So the peak default rates happened around the Great Financial Crisis, where leveraged loan rate defaults were at 10%. So even if 5% sounds relatively high, and it is beyond what we saw in 2020 during the pandemic, from historical standards, it is still relatively low and constructive.
Now, it's interesting, Kelly, you mentioned supply-demand dynamics. How closely are you watching that going into next year, and how drastically would that change pricing?
So for the technicals of the high yield market, they've remained quite strong. Leveraged loans, I think, have seen about $21 billion in inflows into that asset class. On the bond side, we're sitting around $19+ billion. Within loans as well, you've had tremendous amount of CLO creation activity that's boosted demand for that market, since CLOs make up about 2/3 of the overall demand front there. In bonds, again, I think you just have a lot of yield-hungry investors. And in allocating assets within the markets is also just about relative value. So why would bonds stand out versus other asset classes, especially in this rate environment? We remain super short in duration, just about 3 years in total. We're at historically low levels. And this structural component of the market has, in fact, let high yield produce twice the amount of excess returns as a longer duration asset class investment grade over the last 7 quarters. So again, it's about what can high yield offer versus other asset classes. For those investors that are maybe more cautious or defensive, we need to look at things like the equity market. In downdrafts, high yield certainly outperforms in more challenging scenarios too.
Now, one reason I ask about supply demand dynamics, Elizabeth, is because of private credit, which stole the show this year in such a big way, but the leveraged loan markets came back nonetheless. How do you see that push-pull playing out into next year? And do you feel that private credit can steal back some of that glory, such that it would make leveraged loan issuance maybe not as robust as you think?
Private credit, as you know, it really has come into its own right and is full, by many accounts, 1/3 of the leveraged capital markets. Going into 2020, there is that interplay between leveraged loans and high yield debt, and we do expect that to continue. It really depends on where rates are, right? So if we are seeing issuers going to private credit to seek out bespoke financing solutions and maybe more interesting junior capital setups. However, a lot of those, what we have observed is that a lot of those companies are actually coming back into the leveraged loan market to take advantage of the lower spreads. And so there is a lot of going back and forth. And we do expect that trend to continue. Also, with elevated M&A and LBO activity next year, that would also be fuel in the fire for the private credit markets as well.
Elizabeth, thank you so much for joining us. That is Elizabeth Hahn of Fitch Ratings and Kelly Burton of Barings. Thank you both so very much. Have a very happy holiday season. Now, still ahead, the final spread, the holiday week ahead with a light dose of economic data. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, U.S. consumer confidence. Tuesday, new home sales and durable goods in the U.S. And if you can believe it, it's a Christmas week. Wednesday is Christmas Day with most global markets closed, yet you still have economic data the rest of the week. Thursday, U.S. jobless claim and European markets closed for Boxing Day. Friday, U.S. wholesale inventories, some economic data from Japan, and the expected preliminary impeachment hearing for South Korea's President Yoon. And for my final thought, I just wanted to say happy holidays to all and a very happy new year. I'm very excited to see you in 2025 from New York. That does it for us. We'll be back in 2 weeks on January 3rd. This was Real Yield. This is Bloomberg.